We're going to be doing previous UNISA question, May 2013, for AUE3702 actually. The content is very similar for 3702, so we're going to be using this as a revision paper for 3702, but just know this was actually a prior 303 paper. So just when you're reading through that, just bear that in mind. I'm going to start off by just reading the required, so we can see what's requested of us before we go reading through the paragraph. Have a look here. It says, describe the substantive procedures that you will perform to ensure that finished goods are correctly valued at year end. Now, when reading a question like this, there's a few things you need to think about. First of all, they're asking for substantive procedures, which means I'm not worried about controls. And at a 3702 level, you're going to be especially required to know your substantive procedures really well. And then secondly, it asks about finished goods. So one thing you need to think about, if they say finished goods, clearly that means they're in a manufacturing environment. They're not going to say finished goods if they buy and sell products. So manufacturing. And then what do we know about manufacturing? There's obviously a lot of elements making up this process. For example, there's raw materials that go into this. There are overheads. And there's things such as labor. So already, when we're going to be doing our substantive procedures, we can start thinking about how we're going to be breaking our solution down. Then lastly, when they talk about valued at year end, we're not worried about existence, we're not worried about completeness, we want to know that the value of our product is correct. And value, as you all know, means cost times quantity. Now, quantity, you would get that at your stock count. So if they mention anything in the scenario about a stock count was performed, we can already use those sheets to help us with the quantity side of things. And then when they talk about costs, that's when we start thinking about all those things I mentioned there, the overheads, the labor, the raw materials, etc. Break that down. And then go even further. What else is involved in value? Things like obsolescence. So is there any indication that maybe our stock is valued at a too high a value and we need to write it down? Or net realizable values, so selling prices and cost values. All those things we need to be taking into account. Because there is certain information in the scenario that relates to part 2 of the required, I'm just going to quickly go through part 2 as well, just so that we can keep it in the back of our minds as we are reading through the scenario. So part 2 is going to ask you to describe the aspects that you will consider before relying on the work of the engineer, Mark Evans. So just bear that in mind. There's an expert that management uses that we are going to need to assess later on. So as you're reading through the scenario and you see his name come up, just remember that's going to be for part 2. So as we read through the scenario, and what you'll see is it's not a very long scenario, which means that you're going to have to use a little bit, and I don't want to say theory, but it is sort of theory-based, in that you need to understand what substantive procedures are and what types of procedures you'll do when we talk about valuation. So let's read through and see what type of information we can actually take away from this to begin with. So it says, you are the audit manager for the 2013 audit of Tiger Trailers Pty Limited, a manufacturer of standard light duty trailers. So obviously trailers is what we are going to need to be basing our substantive procedures on. Their financial year end is the 28th of February and they have been your client for 4 years. The manufacturing process of trailers is not a complex process and can be easily understood by observing the production process. Now, why are they telling us all this information? Firstly, the fact that they've been our client for 4 years, they manufacture trailers and it's not a complex process and it can be easily understood. We'll see that this information plays a role when it comes to part 2 of the required. We'll get to that a bit later, but just for a heads up, they're going to ask you about the experts and how you'll evaluate their work. So this type of information, we won't disregard it yet. We obviously need it in part 2 and we'll come back to it later on. It says the audit plan indicated no unusual risk of misstating inventory at the assertion level. So we know it's not a risky section. We don't have to go into detailed, complex, substantive procedures, just high level, what type of procedures would you perform to value inventory. You attended the client's annual inventory count and are satisfied with the counting procedures. You have a copy of the final stock count sheets, and you are satisfied that the descriptions and quantities provide a true reflection of the inventory counts at year end. Okay, that's great. That means we attended the inventory count, we've got our stock count sheets, and that now helps us with that quantity side of things that we spoke about earlier. So if we attended the count, we obviously have our count sheets. We would have given them, or management would have had their count sheets. We would have compared and make sure that what we counted is actually reflected in the GL at year end. Or we should hope that that's done, and obviously that will form one of our substantive procedures. But when they refer here, when they say we have a copy of the final stock count sheets, those are management's count sheets that they are referring to here. So we are happy that they've at least provided for the correct descriptions and quantities that from what we counted. The stock count sheets are computerized and reflect the following information: product code with a description, quantity, cost price, and selling price. That's great, because now when we're performing our substantive procedures, we can actually pull pricing, so we can get the selling prices, get the cost prices, and do net realizable values. We can also do things like pulling the quantity and making sure it agrees to what we counted, so that we know we're using the correct quantity in our calculations. The product codes with descriptions, making sure that they counted the correct types of products and that the correct product is actually reflected in the GL at the end of the day. All of these being recorded in the GL will make sure that our total value at the end of the day is correct. If our quantity is incorrect, it means our value is going to be incorrect. So we can't forget about quantity. Next paragraph. The cost accountant provided you with the costing records. Every trailer model has a blueprint with the exact specifications or diagrams, product codes of raw materials used in the manufacturing process, and costing. From this blueprint, the cost price of a trailer is determined and used on the inventory sheets. Now, what I find helps sometimes is just drawing a little picture if I don't quite understand a paragraph. So what I'm seeing here is that you've got your blueprint, right? That is what that cost accountant gives you. On that blueprint for each model, so this is for a trailer, for example, here, it will say raw materials, and we spent X amount. Labor, we spent X amount. Overheads, X amount. And that total, at the end of the day, all these costs, what they add up to, we need to make sure that that amount there goes to our GL. This total will say one trailer in the GL at X amount, and this X amount is what gets reflected there. So this blueprint is quite a handy little tool when it comes to measuring the values or agreeing the values, because on that blueprint it will say what the raw materials are, what the labor heads are, what the overheads are. We can then go and assess all of that for reasonableness, accuracy, perform recalculations, and then make sure that that total value that was on that blueprint is actually what gets recorded in our GL at the end of the day. Okay, so that's what this whole little paragraph is basically saying here. Also, it says here the cost price of a trailer is determined and used on the inventory sheets. So even on the inventory sheets, when they perform the stock count, that total value that was on the inventory sheet is also on this blueprint up here. Okay, so this blueprint is very, very important. Okay, let's carry on reading. Tiger Trailers Limited employs a registered production engineer, Mark Evans, on a contractual basis. This now is where our expert comes in. Mark is our expert. You can see that by the fact that he's not a full-time employee and he comes in on a contractual basis. He's been a contract worker for 5 years and is responsible for ensuring the accuracy of the blueprints. He also certifies the stage of the work in progress. The cost accountant is responsible for costing the items. Yes, the cost accountant still makes sure that we cost them. So he is the one that does this document here. But we've got Mike, who's involved in the blueprint. So he comes in and he makes sure that the blueprints are actually accurate. So as we said earlier, these blueprints are very, very important. Well, now, obviously, this expert is quite important too, because if we need to rely on these blueprints and we've got him to help us, that makes our life a lot easier. But now we need to make sure we can actually rely on his work. And that's when I said part 2 will come into play of the required. Let's carry on reading. It says here, cost is determined on the first in, first out basis. Direct costs of manufacturing and a proportion of manufacturing overheads based on normal operating capacity are included in the cost of the manufactured goods. Okay? So this can help us when we do our substance procedures when it comes to assessing that all the costs are allocated appropriately. When we talk about manufacturing costs, we can go wild with the substantive procedures in that, making sure manufacturing overheads are allocated, making sure it's calculated on correct capacity. We can do recalculations and make sure that what we get is what management's getting, etc., etc. But that just is a little bit of information there. If we scroll down, just gives us a little table over here where it talks about what our inventory values are. So we are obviously valuing this amount here, so the finished goods for 2013. And why they would give you a little table like this, probably help if we're doing analytical procedures. So remember, analytical procedures are substantive procedures, so don't forget about them. There's always a few little marks that you can get awarded for including those analyticals by comparing prior years to current years. Look at the work in progress amounts, see how they've grown from the prior years in comparison to finished goods, in comparison to revenues. See what type of analytical procedures you can actually think of. Okay, so if we go back to part 1, it says again we need to describe the substantive procedures in order to ensure that finished goods are correctly valued. So now based on all the information that we've read, we can now go and put together our substantive procedures, thinking out of the box, what would you do if you were actually at a client, how would you value this, in addition to the information that they've given you, how you can use that to assist us in putting together our procedures. Okay, so let's go to the solution and see how we can answer this. Okay, so it says, substantive procedures to audit the value of finished goods. But before we start, let's just recap quickly. So we know that our finished goods are made up of raw materials, which go to plus labor, plus overheads, and that'll all add up to our finished goods, right? But remember, there's a whole process before we can get to finished goods. We got our inputs, so all of those that we spoke about above, which are our work in progress, our WIP, and once work in progress is completed, we then end up with finished goods. So if I refer back to this original table that we spoke about here, this little table here, this will sort of help us give us our structure so we can remember what inventory is broken down into, so that when we are answering our substantive procedure question, we don't forget about a phase. Remember, this always helps if we've got our little headings in mind. Like when I start off an exam, I kind of have an idea, draw a little mind map, say, how am I going to answer this question? Do little headings for yourself, and that way, as you're answering your solution, you are not, or as you're getting to the solution, you're answering your question, you're making sure you don't leave out anything that's important. Every single mark is important, and you want to make sure you get every mark you can possibly get. So you can use this table and go, okay, we're auditing finished goods, but I need to remember that my finished goods consist of my work in progress, and they consist of my raw materials. So if I cover everything, then I know I'm good, and I'm covering everything that I possibly need to, and I'm not missing out on marks. Okay, so let's go. Little introduction paragraph here that says value of inventory relates to cost times quantity. Costing is broken down between all the elements making up the total cost of the finished goods. Quantity would be obtained from a stock count performed. So it's basically, I'm just recapping on what I mentioned to begin with. Remember now when we start breaking down our solution, we talk about quantity, we talk about costs, and in that cost we talk about all those sub-elements. So let's start. It says here, procedures to ensure that the quantity is correct. You could, on a sample basis, agree the number of units on the final stock count sheets. Now those final stock count sheets, I said, are from management. So we want to make sure the stock count sheets that management has agree to the number of units on the stock count sheets obtained during the inventory count, so our count at year end. So first of all, if what we have counted agrees to what management has, at least I know my quantity is good. Secondly, we could scrutinize those final those final stock count sheets for any unusual items that were not reflected on the count sheets obtained during the inventory count. So if there was anything that we counted that are now, we didn't count, that are now reflected on management's count sheet, so that shouldn't be there, that'll be a problem. We want to make sure that only the things that we counted are reflected on management's count sheets. Okay, moving on to general procedures relating to the costing of the finished goods. Before we go through those, I just want to remind you, don't forget, when you are doing substantive procedures, you answer it according to the how, what, and why. This makes sure you are doing complete sentences. We don't want to do just statements and points. You're not going to get marks for that. You get marks by doing full sentences explaining what you are doing, why you are doing it, and how you are doing it. That way we ensure we get all our marks. So for example, this number 1 that we're going to go through here, it says discuss the blueprints with Evans, he's the expert, to obtain a general understanding of the diagram and the costing. Okay. So how are we going to be doing this? We're going to be discussing the blueprints with Evan. What are we discussing? The blueprints, or what are we doing? We're discussing the blueprints to obtain a general understanding. Okay, that is your why. So this whole sentence is a full sentence. If it just said discuss the blueprints, that would be a statement that wouldn't have any verb, it wouldn't have any whys or whats or hows, or it just would not be complete and you wouldn't get those full marks. So every time you are doing a substance procedure, look at it afterwards and go, have I answered how, what, and why? And next one, we could also observe the manufacturing process and establish the reasonableness of the components. So we want to understand, how do the raw materials and overheads, how do they all fit in? How do they work? And are they reflected correctly on those blueprints? Okay, full sentence once again. Observing, what are we observing? The manufacturing process. And why? Because we want to establish the reasonableness of the components. Okay, once again, full sentence. So I'm hoping you're seeing the trend here, and when you're practicing questions, you're practicing these techniques. Okay, we want to make sure you get full marks here. Okay, next thing, we can compare the blueprints. So the components, the quantities, and the measurements. Remember I spoke about that little diagram, and I said on that diagram lists the breakdown of how that trailer is costed. So it says you compare the blueprints with its components, quantities, and measurements with the previous year's working papers, to establish the consistency in the costing and obtain explanations for any variances. And then lastly, we can cast the costing. So cast that blueprint. Casting means add it up. Okay, we want to make sure that if we take our calculator and we add up every line item, will that total agree to what management has? Yes or no? So we're going to cast the costing of the blueprints and agree that total of that unit price of the trailer model with the unit price reflected in the stock count sheets, making sure that what's sitting here, that final value, is sitting in our GL and our stock count sheets. Okay, those need to agree. Okay, next thing, we're going to obtain the blueprints and perform the following to test the cost of the trailers. Now remember I spoke about earlier when I said costs are broken down into raw materials, labor, etc., etc. This is a nice little structure that we can use to make sure we cover all the elements. We might forget that it's made up of raw materials, but if we put it down, we put down our headings and we look at that diagram that they gave us earlier, we'll make sure we cover everything. So for raw materials, we could agree those component codes and unit cost prices used in the blueprints with those reflected in the cost stock count sheets for the respective raw materials. We could trace the unit prices of the components to the relevant suppliers' invoices. Now that's a good one. We need to make sure that the amount that we're using for the cost is actually what we paid for it. And the best way to do that would be to trace it to that supplier's invoice to establish whether the correct prices have been used in terms of the FIFO. Remember they said they talked about the FIFO? So by tracing it through to that relevant supplier's invoice, we'll make sure they're actually doing this FIFO formula correctly. Okay, for labor, we could examine the labor hours used to manufacture a trailer model and compare those number of hours with the previous year's costing. Okay, see if it's reasonable. If last year or if last month they were using 100 labor hours and this time around they're using 300 labor hours, that wouldn't seem reasonable. Why would they go up so much? It should be theoretically consistent. Okay, we could also agree that hourly rate used in the blueprint with the hourly wage rate in the wage records. And make sure that we're charging it correctly. If somebody's getting paid 5 Rand an hour, we need to make sure that that 5 Rand an hour is reflected, not 10 Rand or 15 Rand. We need to make sure that the correct wage rate is used. Okay, for overheads, we could inquire from that cost accountant. Remember, he has that costing for the overheads. And we can ask Evans. He's our expert. Remember? Regarding the basis of allocation of overheads and the reasonableness thereof. So are they allocating these overheads correctly? Are they thumb-sucking it, or is there actually a reasonable way that they're allocating these to the final product? We could recalculate. Okay, remember, that's a very good one. Recalculate the allocated manufacturing overheads with reference to the approved allocation basis. Okay, approved, not one that we've just made up. What is their approved basis, and make sure they're doing it correctly. And the use of accurate information pertaining to the normal operating capacity. Okay, so by recalculating what they actually have authorized, we'll make sure that they're doing it correctly and they're following their own policies in the appropriate way. Yeah. Also got your next little heading. Now you'll see along the way, I haven't pointed it out specifically, but along the way I've underlined specific headings. And that's just to make sure that we are structuring our solution appropriately. We're making sure we're covering everything we could. And it also helps the marker. If you put a heading there that says stock obsolescence, they then know that these next 3 points relate to stock obsolescence. You haven't got one point relating to stock obsolescence, and then you'll talk about the valuation based on the raw materials, and then you go back to stock obsolescence. It's very confusing and unstructured, and it doesn't help the marker ensure that you get the most marks. So by putting little headings, you can put as many headings as you like along the way. However you want to structure it to make sure that the points that you speak about talk about a specific heading, it's a really useful technique, and it'll help ensure that your allocation or the way that you're going through the solution is done in the appropriate way and you don't confuse yourself. Okay, so back to this. It says, for the first one, compare the selling price on the approved price list or invoices around year end with the cost price on the inventory list to ensure that it is higher than the cost price. Now, this is a perfect example of an NRV test, net realizable value test. We want to make sure that what we sell for the product, what we sell the product for, is higher than what it cost us to actually manufacture that product. If we were selling it for less than the cost price, we would be making a loss, and it means that our inventory is not valued correctly, and we need to mark that value down. Okay, so NRV test, perfect example. Where those selling prices are lower than our cost prices, we need to request management to make the required adjustment to net realizable value. Also very important in terms of IAS 2. Okay, accounting plays a very important role in these types of solutions. Number 3, inspect the stock count sheets for finished goods identified during the count as damaged and obsolete. Discuss this with management and write off where appropriate, and then trace those journal entries to the general ledger. So basically, once we were doing our stock counts, if there was anything sitting in a corner that looked damaged or we won't be able to sell it for what it's worth, that's a red flag. We'll need to mark that during the stock counts. Then discuss that with management. Make sure they also agree, yes, that is damaged and I need to write that off. Then make sure that even though they've agreed to do that, they've actually done that by creating journal entries to adjust that value of inventory. Okay, we can't just audit according to discussion. We need to make sure that management actually does the appropriate thing. So make sure they actually did those journal entries and they've written that stock down. Okay. See another little heading here. These are general procedures. With every question where they talk about substantive procedures, don't forget you get general procedures, and those are kind of like your buffering procedures that are general across all types of substantive procedure questions you can get. Those are your management rep letters, your costing, your cross-costing, your opening balances, etc., etc. Don't forget about those. It's a good 6, 7, 8 marks there. Says, cast and cross-cast the stock count sheets for finished goods. Okay, so we're taking our stock count sheets, adding them, re-adding them, making sure the totals are correct. Secondly, trace the value of finished goods per the stock count sheets and agree it to the inventory control account in the general ledger and trial balance. So were those values that we counted at the stock count, were they correctly entered into the GL at year end? Okay. Number 3, determine through inquiries. Is your how again? Determine through inquiries from management and the sales staff, as well as by inspection of the minutes and correspondence files, whether any of the inventory items are subject to any special sales conditions. So is there anything there we need to be aware of? Maybe we need to adjust the value of inventory there. Okay. Number 4, inspect the financial statements for the accounting policy with regard to inventory and ensure that it is appropriate and applied consistently. So look at those financials. See last year, what was the disclosure regarding inventory? What was their policy? And is that policy the same this year? If not, why? Generally, policies need to be consistent. Okay. Number 5, agree the amount in the trial balance to the amount of finished goods disclosed in the notes to the financial statements. So the amount that was sitting in our TB needs to go through to our finished goods in our financials. Okay, so here we spoke about the policy. So is the policy consistent? Here we want to make sure that the actual finished goods line item, so the actual amount in inventory, is the amount sitting in our financial statements. Then number 6, it says inspect the financial statement presentation and disclosure and ensure that is consistent with the evidence collected. So here we're talking about policy, then we talk about the amount, then we talk about presentation and disclosure. Has it been presented and disclosed correctly in accordance with priors, and is it consistent, and is it appropriately disclosed? Number 7, obtain a management representation letter with regards to the inventory value as at year end. Okay, that's a very general one. Make sure when you talk about management rep letter, you are specifically saying what you want from management. Don't just put there as a point, obtain a management rep letter. You're not going to get a mark for that. Obtain a management rep letter for what? Why do you want one? Be specific regards to the inventory value at year end. Okay, number 8, perform analytical procedures such as comparing finished goods balances with the prior year. So when we talk about analytical procedures, just make sure you give a few examples. Don't just say perform analytical procedures. Okay, they're going to want to know what analytical procedures, why, how, etc. So compare finished goods balances with prior year, or calculate inventory turnover days as a percentage of revenue and compare that with the prior year. Perform trend analysis of component costing. So compare the cost of your raw materials from last year to this year, labor last year to this year, and compare all of these with the corresponding figures of prior years and obtain acceptable explanations for any deviations. Now, I mean, think of anything. It doesn't have to be specific here. These are examples of analytical procedures, but think, what kind of procedures could you perform in order to assist you in identifying whether values appear reasonable or not? One other thing I'd just like to point out quickly is that we didn't speak about the use of CATs. Now, in the beginning, as part of our required, they mentioned here that the stock count sheets are computerized and reflect the following information: product code with description, quantity, cost price, and selling price. So the fact that they are computerized already means we could potentially use CATs. Now, we didn't specifically refer to it in the solution, which is why I'd like to go back and just point out where we could have actually used CATs. So if we read through, we'll see things like scrutinizing the final stock count sheets for any unusual items. We could use CATs to do something like that if we were specific. We have to say scrutinize it for unusual items such as negative items. Remember, inventory shouldn't have a negative value. Or if we've got a stock count, we've got a quantity with no description, for example, like why are there values without descriptions? Anything that seems a bit weird that shouldn't be there, we could use CATs to help us with. We've got things like, where else could we do? We obviously couldn't discuss using CATs because that's a human thing. But for example, if we wanted to compare the blueprints with previous year's working papers, that's something we could get CATs to help us perform. And especially when it comes to casting things, we could use CATs for that. So maybe have as a sub procedure or a heading that says use CATs to perform procedures and list the type of procedures we could get CATs to do for us. So it's high level. We could do things like, provided we've got certain documents in a computerized form, we could agree the hourly rate used in the blueprint with the wage records. But remember, these things have to be in a computerized form. We can't use CATs to assess a manual document. So just remember to bear that in mind. We can always use CATs to recalculate things. So whenever there's a list to recalculate or a calculation to redo, CATs could help us there. And they're especially relevant when it comes to assessing selling prices versus cost prices. So they mentioned in the scenario that you can pull the computerized record that's got selling prices, cost prices, etc. We could get CATs to give us a list of where selling prices are lower than our cost, and we could follow up those with management. We can also use CATs to help us with analytical procedures. So it says perform analytical review procedures. We can definitely use them to help us compare one financial period with another financial period, or look at things like raw materials and recalculate ratios, etc., etc. So wherever there's a potential to use CATs, let's not forget about them. We can include them in our solution and earn a few marks for them as well. Okay, let's move on to part 2 of our required. We'll go back up to the top. It says here, describe the aspects that you will consider before relying on the work of the engineer. Now, the engineer in this case, Mike Evans, is our expert. So when they talk about things like describe the aspects that you will consider, we need to think of what do we have to think about before we can go and use the work of this expert. Remember, there's things like, is he skilled? Is he competent? Is he a member of a registered body? Has he been doing this for long? Etc., etc. We are not going to go and rely on somebody's work if they don't have experience in it. Right? Remember, this isn't a complex thing either. They've mentioned before that they don't expect any material misstatements, and this process isn't a complex process. So theoretically, we don't need a highly skilled expert in this case, but we do need somebody that knows what they're doing. If we are relying on their work at the end of the day, we need to make sure that those numbers that end up in the financial statements are correct. So we need to make sure we are relying on an appropriate person. Okay, so let's go back up to the top here where it says, we talk about Mike. It says here, Mike, well, Tiger Trailer Limited employs a registered production engineer, Mike Evans. The fact that he is a registered production engineer already gives us information that perhaps he is a member of a registered body. Right? He's obviously a professional. You're not going to be registered with someone if you're not a professional. And he's on a contractual basis. So by being on a contractual basis means that he's not a full-time employee of Tiger Trailers. Now, when we're considering relying on an expert, firstly, we need to consider, are we relying on management's expert or are we relying on the auditor's expert? Now, in both cases, we need to assess things like skills and competence. However, when we're relying on management's expert, you need to go one step above and beyond when considering independence. Because now that management is paying them, there's more of a threat to independence and objectivity. So we need to just focus our procedures a bit more there. But over and above that, very similar to the procedures we would do when relying on an auditor's expert. Okay, so it says Evans has been a contract worker for 5 years. So clearly he has some kind of experience. He's not new at this. That helps us a bit. And he is responsible for ensuring the accuracy of the blueprints. He also certifies the stage of the work in progress. The cost accountant is responsible for costing the items, and cost is determined on the first in, first out basis. So we already used all this information in answering part 1 of our question. Part 2 is now specific when it comes to Mike. So once again, part of exam technique, think about what are the headings that I want to use. What is the structure of my solution going to be? And think about the type of points that you're going to put down. Remember, if you start writing a whole paragraph, it's going to be very difficult for that marker to pick out the points for you. So you want to be clear, you want to be specific, but you want to make sure that you're using full sentences, not statements. We want to still answer the how, the what, the why, make sure we're answering our full statements here. Okay, so let's go look at our solution. It says aspects to consider before relying on the work of management's expert. Now, when we talk about management's expert, we refer to ISO 500. Okay, and there they'll give you the list of the different things you would need to consider. But for your purposes, at a 3702 level, you obviously don't have an open book next to you. So I don't expect you to quote offhand different paragraph numbers, but if you do know the ISOs, put them down. It can only help you. So I've put little headings here. So the first thing we're going to consider is the competence, capabilities, and objectivity of management's experts. So we need to consider the following things when assessing the expert's skills and competence. In this case, the inventory composition is not too complex, and observing the production process with the blueprints should not be a complex exercise. That theoretically means that we don't need somebody that's highly skilled and they've been in the business for 20 years. This process is very simple. They need to have some kind of, they need to know what they're doing. They need to have some kind of experience in this so that we can rely on them. We're not using a first year that's just qualified from university and never done this before. So in this case, the inventory composition is not too complex, so it's not something that's highly specialized. It says the audit plan indicated no unusual risk of misstating the inventory. Okay, so it's not a highly risky section. There shouldn't be something that's, it's difficult to value. So for example, if you're valuing chemicals, there'd be a whole bunch of factors taken into account and we'd need somebody that's highly skilled. In this case, there's no unusual risk. It's plain, simple, straightforward inventory. Okay, so based on that, competence and capabilities, right? Evan is a qualified engineer and possibly belongs to a professional society that has ethical standards and therefore a certain amount of professionalism can be expected from his work. So he seems to be quite competent. And as a registered production engineer, Evans is likely to have the skills and competence to carry out the tasks. So we've assessed his competence and capabilities. He seems to be competent so far. Next thing, the important one as well, independence and objectivity. As we mentioned earlier, the fact that he works for management, this is a very important heading. So we would need to consider situations or events that may threaten Evans' objectivity. So is he familiar with the client? Are there any intimidation threats? He has been employed for the last 4 years, but you never know if there's something behind the scenes where management is intimidating him and saying, if you don't tell the auditors what they want to hear, I'm not going to employ you next year. Just a high-level example there. But you don't know what goes on behind the scenes, so it's something that we always need to bear in mind. Evans is employed by the entity on a contractual basis, so it's not full-time, allowing scope for independence compared to a permanent employee. If he was somebody that was on the payroll of management, it's highly unlikely we would consider him independent and objective. So in this case, the fact that he's contractual, that bodes well. On the other hand, there is still a threat that management could exercise control over or influence the work of Evan, and once again, this should be kept in mind. Okay, the next thing we need to do is obtain an understanding of the work. So we need to understand, what does this expert do? We can't assess something that somebody does if we don't understand what they do in the first place. So very important, let's get an understanding. And how do we do that? We would hold discussions with Evans to familiarize ourselves with the nature, scope, and extent of his work. Okay, no better way to obtain understanding than to actually go and talk to the person. But in addition, we don't just audit by word or discussion alone. We always need to go and look at some hard evidence. So once we've discussed with him, we would still do other procedures to make sure that what he says is actually true. So the nature and scope and objective of Evan's work is relatively easy to understand and can be verified through actually observing the production process. So whatever he says that he does when it comes to assessing the blueprints, we could actually go and observe and see, how does this production process work and is it in line with his work? Next, the cost accountant performs the costings. So remember I said earlier, cost accountant does the costings. So we can hold discussions with him to see if anything on the blueprint bothers him. If he raises a red flag about something on the blueprint, then we should maybe go and investigate further. Next one, the auditor has previous experience with this client and therefore with the experts, and we would know if there are any risks. So remember right at the beginning it said that we've been on this client for 4 years. So this isn't the first time we would have dealt with this expert. So based on how we've seen things in the past and based on his work in the past, this would now help us in the current year as well. Okay. Next, we would need to evaluate the appropriateness of that expert's work. So remember, we've understood it, we've obtained an understanding, he's told us what he's going to be doing. Now we need to actually get his work and evaluate it and see, is it any good? So the fact that per the auditing reporting schedule, there is uncertainty regarding the company's ability to continue as a going concern, this would result in an increased risk for the overstatement of inventory, affecting the existence and valuation and allocation assertions. We would therefore need to consider if the work performed by Evan actually addressed those relevant risks. But there's no point in him giving us work that doesn't address the risks that we have in the first place. So if we see as part of his work he's actually addressed the existence and valuation assertions, then we'd be happy. Next, we'd also need to see if alternative sources of audit evidence can be used, such as prior year's working papers and analytical review procedures to substantiate Evan's findings. So is there anything else that we can use as a backup, where one bit of audit evidence actually speaks to another bit of audit evidence? And if it does, then that's great. We need to make sure that all our evidence is conclusive, it works together, there's no missing pieces, and nothing stands out as being out of the audit area. I just want to point out that this point over here might stand out a little bit now, and you might be thinking, oh, but I didn't see that anywhere. You wouldn't have actually seen this anywhere. It comes up in part 6 of the required. Right? But because we are doing this bit by bit and we're doing part 1 and then reading information, you wouldn't have read through the whole scenario just yet. But in an exam situation, you would read through the whole of the required. You would highlight things along the way, highlight information from your scenario, so that when you answer questions, you're answering it based on the entire paper. But that's why making headings is so important. Because if you make headings along the way when you structure your answer, and you come back, you read through the required later on, and you see something later down the line that actually relates to part 1 of your required, you can always go back and slot it under that right heading. Okay, but just for purposes of the way we're doing this paper today, we're reading a bit of information and answering bits of requireds along the way. So don't be scared if you thought, oh, I didn't read this anyway. You wouldn't have read it yet. It would have come out later. Okay, so I just want to bear that in mind in case you don't know where this has come from. Okay, we're going to move on to part 3 of our required. So this one is we need to do the substantive procedures for a journal entry adjustment. Remember, whenever there is an adjustment to something in the accounting records, especially like a credit note policy or something, we need to make sure that those journal entries are correct. So it says here, describe the audit procedures that you will perform to audit the journal entry providing for the credit note. So what are we going to do substantively wise? What are we going to do to make sure that that journal entry is actually appropriate? Let's read through our scenario. It says Tiger Trailer Limited accepts returns of goods sold. Because whenever they accept something that has previously been sold, there needs to be an adjustment. They have a policy that makes provision relating to sales before year end. So what is their policy? How do they make provision for this? How do they know that what they're adjusting is actually appropriate? And that's where we come in. It says it is company policy to provide for 2% of sales, and in this case 2% of February sales. The journal entry is debit sales and credit provision for credit notes. They've obviously taken the amount per sale, so there's 2 million here. Now it's gone into two separate lines, so it's not very easy to read, but it's 2,975,012 Rand. They've taken that amount per the February sales and times it by 2%. So what do we need to do in order to audit this? Okay, now we need to consider certain things here. The fact that there is a provision. Okay, what is a provision? It is an estimate, right? So the fact that management has an estimate in this case, how do we audit management's estimates? What do we need to consider? Things like, is the provision reasonable? Is the policy reasonable? Are the assumptions that they've used, are they appropriate? Remember, management can't just wake up one day and decide that they're going to use 2%, for example. There needs to be some kind of a basis of allocation for this, and we need to audit this, make sure, does it seem reasonable? Is it in line with maybe other industries out there, or is it consistent with prior years? How accurate is it? So, for example, if they've been calculating this month on month, how do we know that they are actually good at calculating this? We'd obviously go and see, well, what was the provision last month? What was the actual amount that was written off, and does it compare? Often, if what management is providing for is completely far out to what the actual amount is, well, then they're not using the correct amount to begin with in the first place. Let's go through to our solution here. It says we are going to be auditing the credit note journal entry. Okay, remember once again the structure of your answer. So in this case, we'll see if we scroll down, they've got general procedures at the bottom, and then obviously specific procedures at the top. But don't forget your how, what, and why. Make sure that those procedures are answering each of these. Okay, make sure we're not doing little statements, we're actually answering the question. So first one, we need to obtain an understanding of the credit note provision by discussing this with management. So how, what, and why? We're going to obtain an understanding. Obtain what? Understanding of the credit note provision. Okay, we need to understand it. We need to discuss it with management. See, is it appropriate? Is it in line with prior years? Well, as I said earlier, we cannot audit something that we don't have an understanding of in the first place. So first things first, let's understand this. Let's discuss with management, see how it works. Number two, we could review the policy documents. So this is the provision policy, right? Review those policy documents to identify if they are in line with management's explanation. So remember, we don't audit by discussion. Here we discussed. Secondly, we went to go and have a look at the documents. Do they speak to each other? Is what management's saying correct? Number three, compare the policy to the prior year working papers to ensure that it is consistent. So we want to make sure that management isn't deciding one year to do 3%, the next year 2%. It needs to be a consistent policy. Number four, consider whether the data and assumptions used by management in calculating this provision appear reasonable. How do we do this? We can compare the assumptions and percentages used to the prior year. We can compare it to industries or trends or maybe the general economic environment. So that's how we see how are they appropriate, how are the assumptions used correct. Okay. We can analyze, sorry about that, I just pressed down a bit too far. Analyze the credit notes passed during the year and correlate the figures with the adequacy of the provision. So in this case, it's a retrospective review. We've gone and seen what are the actual credit notes that have been passed during the year, and what was the provision that management provided for this? Do they speak to each other or not? And generally, if they speak to each other and management provides for example, 100,000 and we wrote off close to 100,000, then generally the provision would appear reasonable. But if they're providing for 100,000 and we only write off 20,000, well, then something's not right there. So how accurate is management in actually calculating this provision? Number six, we could compare the acceptability of this provision with the trend of provisions for the previous months. We could discuss the provision of the credit note with the sales manager and the credit controller to determine whether or not it is sufficient. Generally, these guys, like a sales manager or a credit controller, those are the guys that are actually involved in the sales day-to-day. So we could have a chat to them, see how many credit notes do they expect to be returned every month, or is what management providing for, does it seem appropriate? These guys are the experts in their division. So we could have a chat to them and see, is management calculating the correct thing here? We could review client correspondence to indicate customer dissatisfaction or audit discrepancies to determine if this provision is actually adequate. General procedures. Don't forget your general ones. Remember I said earlier with inventory, if we can get a few extra marks for general procedures regardless of what we are testing. So here it comes up again. Number 9, recalculate the provision at 2% of the credit sales and agree it with the client's provision. We can agree the February total in the sales journal with the figure used in the journal calculation. Now remember that was that 2 million rand in the journal. We need to make sure that that actual sales amount that they used is actually correct. And how do we know that? We can recast that sales journal, make sure it agrees to that 2 million rand because that is the one that they're using to do their calculation on. And if that is incorrect, well then the provision is going to be incorrect. Okay, we can trace the posting of the journal entry to the sales and provision for credit note accounts. So that was that actual journal entry up here when it said debit sales, credit provision for credit notes. Right? We can go back, trace through, is this amount sitting in the sales journal? Is this amount sitting in the provision for credit notes? Yeah, we can trace the previous year's journal to the general ledger to ascertain that it has been reversed. Remember, whenever we have a provision and then we need to reverse that provision when we put through the actuals. So has that provision actually been reversed, or do they just keep providing year on year or month on month and without ever reversing it? We need to reverse that. Okay, obtain a management representation that refers to the provision, its appropriateness, and then nothing has come to management's attention to provide otherwise. Remember, as I said before, when we speak about a management rep letter, don't just say obtain a management rep letter, you need to be specific. Okay, number 15, perform detailed analytical procedures on that provision. Nice extra little marks there. Don't forget, analytical procedures are substantive procedures. So put in there examples of what type of analytical procedures you could do. Compare the ratio of credit notes to sales per month. Or compare the budgeted provision and the previous year's provisions. Are they in line? Just give some examples of what you could do to assess the reasonableness of this amount. Okay, let's move on to question 4. Scroll down. It's a subsequent events question. Says for number 4, explain the 2 types of subsequent events identified by ISA 560, subsequent events, and the respective accounting treatment thereof. This is very much a theory question. So what do we remember about subsequent events? There's obviously 2 types that we can get. We need to state what they are and just explain them. And number 5, list the procedures to identify subsequent events. Also a theory question. Okay, so we're not going to get any information really from the scenario here. It's going to be if you were auditing a client, what would you do to identify subsequent events? And when you do, what are the 2 types and how do we treat them? Okay, so let's just read what they've given us here. It says, on reviewing the previous year's audit program for subsequent events, you noticed that the audit procedures were either poorly formulated or incomplete. You plan to reformulate them so that the audit trainee is able to understand exactly what he has to do when executing them. In preparing the audit trainee to perform the subsequent events procedures, you explain the accounting principles of subsequent events to him. Okay, so firstly, part 4. We need to explain those 2 types of events. If we get evident, first of all, there's 2 types, right? You get adjusting and non-adjusting, and we'll read through those 2 now. But firstly, it says those that provide evidence of conditions that existed at the date of the financial statements. So at year end. If there was evidence of anything that happened at that year end date, that would be considered an adjusting event. So these will be subsequent events requiring adjustment in the financial statements, right? The second type you would get were those that arose after year end. So if our year end is the 31st of December, there's information that happens up to this point, so up to the date of the 31st of December, and then we get events that take place from this financial year end date onwards. Okay? And these would be considered the non-adjusting or adjusting. It just depends when it takes place. So number 2, those that provide evidence of conditions that arose after year end. These will be subsequent events requiring disclosure in the annual financial statement. So anything that happened here after year end, we would need to disclose it. So it says, for events which do not relate to conditions existing at balance sheet date, so at this date here, but are of such importance that non-disclosure would affect the ability of the user of financial statements to make proper evaluations and discussions. So it means if anything took place after year end here and we don't disclose it, it's going to affect those decisions of users. But anything that takes place here, we need to adjust because it actually affects our numbers. And those are the numbers that we report on. Okay, so we just needed to explain that, the fact that there's adjusting, non-adjusting, and how do we treat those. Theory question straight out of ISA 560. Question 5, we now need to discuss what types of procedures would we perform in order to identify subsequent events. Now this, once again, very much a theory question. What would you do if you're out of the client now and you need to identify if there's anything that happened after year end that we need to either adjust or disclose? How would we go about doing this? So let's go through. We could review the procedures performed by management to identify events after the balance sheet date. So what has management done to identify these? Have a look. If there's anything that they've done, maybe we could go and re-perform it and see if we also pick up the same things, or if we pick up anything over and above that. A very good place to look is actually the minutes. Remember, directors sit in meetings and everything they talk about in those meetings gets documented. And if there was anything material, they would discuss it at that meeting and it would be minuted, and we could go review those minutes, and it would be a great place to start and see if there's anything we should identify. So we could expect minutes of the shareholders' meetings, board of directors meetings, audit committee, it's a good one, board committee meetings, etc. for the period after year end. So go get that minute book from the 31st of December or 1st of January onwards. If 31st of December is your year end, and have a look, read through those minutes, see if there's anything that they've mentioned. We could also inquire on relevant matters where minutes are not available. So if they haven't had any meetings yet, have a chat with those guys that sit on the board, have a chat with the shareholders, have a chat with the audit committee, see if there's anything that they are aware of that they haven't actually spoken about in their meetings yet. Okay. We could review the latest available information. So for example, interim financial statements, depending how long we are there after year end. Look at their budgets, their cash flow forecasts, their management reports. Look at their books after year end. Is there anything that raises a red flag that we should be aware of? Yeah, we could inquire from their legal advisors. That's a very, very big one. If there's any litigations or something going on, we would need to find out the status. So maybe at year end we weren't too sure on a pending litigation, and after year end there's now a result, but that would impact us. But the only way we'd know about that is by actually discussing with these legal guys. Okay, number 5, consider relevant information which came to the auditor's attention from sources outside the entity. Right, so you could also think like internet, for example. If there's anything that's on the news about your clients, or maybe the banks, or anything that's not part of the entity that we could get information from, we consider them. We could scrutinize prior year working papers to identify types of events that have occurred previously. We could inquire from management whether subsequent events had occurred which could affect the financial statements, such as have they taken out any new commitments or borrowings, or maybe they've decided to acquire new assets, or a big portion of their operations they decide to sell. Maybe there's developments regarding their contingencies, so maybe now they have actual liabilities instead of just a contingency. Inquire if there's any unusual accounting adjustments, or if the accounting policies are appropriate, maybe they've changed some policies. And lastly, events that have occurred relevant to the measurement of estimates or provisions. So what are the actuals now after year end, and we can assess whether those estimates were correct at year end. And finally, as always, don't forget our management rep letter. Always get a mark for that, referring to the appropriate treatment of subsequent events, being specific here once again. Just from an exam technique point of view, I want to point out for number 7, right, it said here, inquire from management. Now, most people would just say, inquire from management whether subsequent events had occurred, right? You would have got 1.5 marks for that. But remember, in the standard, they actually list different examples of things that you need to inquire from management. And just by breaking them down and listing them, you're getting 1.5 marks for each one. So out of your 18 marks, right, you're getting 10 marks just from saying what documents to inquire from management. If you had just said, inquire from management whether subsequent events had occurred, there's 1.5. You're missing all of these marks. So just remember, from an exam technique point of view, break it down. What can you inquire from management? Like, there's different things. Don't just put 1 point and expect that that's enough, right? Break it down. Think of the standard. Think of how it's broken down in the different examples that they give you there, and make sure you put them in. I don't want you losing out on easy marks. Okay, moving on to our last required 6. This has got to do with audit reporting issues. So it says, on completion of the audit partner gave you the following schedule of issues that could affect the audit reports. And we see there's a whole bunch of missing things. We obviously need to fill in the blanks here. So let's go down. It says, complete the audit reporting schedule of the issues that could affect the audit report. Number your answer in accordance with the schedule. So obviously in your solution, you would say 6.1 and you'd fill in the solution. 6.2 and you'd fill in the solution. But for our purposes, we're just going to fill it in directly on the table here. So they've given us an example. It says, if the conclusion in the audit file is, for example, that there are no cash records, the nature of the matter, so what is the nature in this case? It says insufficient appropriate evidence, which would lead to a scope limitation. Now, the effect of the misstatements of the financial statements would obviously be fundamental. Cash is a fundamental area. And your effect on your report would be a disclaimer. Okay, so now remember, when we're answering this type of a question, we need to first think, I'm just going to move down here where there's a bit of space. We need to think, first of all, there's two decisions. So number one, have we got a disagreement with management? Or is it a limitation of scope? Okay? And based on that, we would come to a solution, we would come to an answer. So we're going to say, is it a disagreement or limitation? And number two, is it material? Or is it material and pervasive? So that would be fundamental. Okay. And depending on how you answer these two questions, would give you your answer. So it would either be a qualified opinion, or you would have a disclaimer of opinion, or an adverse opinion. If you've got a disagreement that is material, or a limitation of scope that is material, in both of those cases, it would be a qualified except for opinion. Okay? Only when it's material and pervasive would it give you the two other opinions. So if it's a disagreement that's material and pervasive, you would go adverse. Or if it's a limitation and it's material and pervasive, it would be a disclaimer. Okay, so when we're answering our questions about this, just bear that in mind. It will help us. Sometimes when answering a question like this, and what I always used to do for myself, was just put these little points down so that when I'm filling in the blanks here, I can follow my little decision tree and it would lead me to the correct answer. Don't just try and thumb suck it each time, because it's going to really confuse you. So just put a little structure down for yourself, follow your little decision tree, and you shouldn't go wrong. So number one, it says the provision in respect of the credit note policy was understated by a material amount. Okay, so the fact that it's understated, we've got here a disagreement with management. There's no limitation. They haven't limited us information or anything here, so obviously we're going to go with disagreement. Oh, it's not fitting in here, so I'm just going to squash it. The effect, would it be fundamental or just material? Okay, in this case, it would just be material. The fact that the credit note provision policy is understated by a material amount wouldn't affect the entire financials. So we go with material here. And as we spoke about earlier, if it's a disagreement and it's material, it's going to be our qualified. So we're going to say our qualified, and we'll just put next to that except for, just so that they know what type of qualified. Okay, number two, the ability of target trailers to continue as a going concern in the foreseeable future depends on negotiations which will be finalized after the financial statements are issued. Disclosure of this fact has been made. So there's no disagreement here. We've got a going concern sort of issue here, but the fact is that it's been disclosed. So there's no argument here. Management has done what they needed to do. The material uncertainty will obviously only happen and will only come out in the future. So it says the going concern in the foreseeable future depends on negotiations finalized after financial statements are issued. So it's only something that's going to happen at a later date. So we don't know now whether they're going to be a going concern or not. It's only going to be told in the future. But right now it has been disclosed. So they've done what they needed to do. Management has performed the appropriate thing. So in this case, it has been adequately disclosed. We haven't got a disagreement. We haven't got a limitation. It's been disclosed correctly. It is fundamental to the user's understanding. Okay, a going concern issue is a fundamental issue. If they're not going to be around in the near future, I think the shareholders need to be aware of that. And in this case, we would just do an emphasis of matter. Couldn't really use our decision tree for this one because of the fact it was neither a disagreement nor a limitation. Had to do it with a going concern that was adequately disclosed. And we would just need to point out an emphasis of matter, bearing in mind you can only do an emphasis of matter if they've actually disclosed something. because what an emphasis of matter does is point the attention of those users of the financial statements to something specific that we need to make sure that they read. And we can't point them to something that hasn't been disclosed, right? So emphasis of matter, when something has been disclosed, let's point them out so that they can actually read it. And then lastly, number 3, various transactions took place during the year between the audit client and a related party. These transactions took place at well below the market price. So we haven't got an arm's length transaction yet. No disclosures of the related party transactions have been made. Okay, that's a problem. This has a major effect on the apps and as a result causes the apps to be misleading as a whole. So they've already told you that the entire financial statements are misleading, which would mean it's fundamental, right? So it's a material misstatement. We've got a disagreement with management. Once again, they haven't limited us to any information. It's a disagreement. They're supposed to disclose something that they haven't. It is fundamental. Okay, it's material and pervasive in this case. Okay, so we've got a disagreement that's material and pervasive. So what do we say down here? Disagreements, material and pervasive gives us an adverse. Okay, so that is the type of opinion we're going to issue. Yeah. And that therefore concludes AUE 303 used for 3702 revision purposes. Good luck.